We see two very large trends happening in the communications industry right now. The first is network convergence, or network unification, if you will. Basically, at its root, network convergence is the coming together of previously separate networks. So your networks for wireless and fixed line telephony, broadband internet access, and video into a single network that's available on demand to customers on a device of their choosing. The second major trend that's happening in communications right now is just the emergence of video as being kind of a killer application. So we may not all be making video phone calls right now, but video is emerging in places that we didn't think would happen over IP networks. Simply put, video is a bandwidth hog, using bits per second or bytes per second in orders of magnitude greater than a telephone conversation or simply an email message sent over the internet. Cisco's dominance in IP networking is undeniable. They have a #1 market share in virtually every market that they serve. And so as service providers and enterprises around the world decide to move to one converged network over the next 4 or 5 years, Cisco will benefit as service providers spend on new routers, new switches, and the like. We originally purchased Cisco shares for our clients' core portfolios in the fall of 2006. And over the last year, Cisco shares have had a tremendous run-up. However, we still view Cisco as being attractively valued. At today's current share price of just under $32, Cisco is trading at roughly 17 times next year's earnings, which compares to its overall earnings growth rate of more than 20% a year. In addition, Cisco generates in excess of $8 billion of cash on an annual basis and has more than $20 billion of cash sitting on the balance sheet. We think that this provides Cisco with the flexibility to make strategic acquisitions, buy back its shares in the open market, and eventually reward shareholders through dividends.